Welcome to the Explainer. Today, we're tackling something incredibly ambitious. We are looking at the ultimate blueprint for building a stock trading and investment app in 2026. Basically, we're talking about constructing a high-performance financial machine entirely from scratch. And listen, the stakes here are absolutely massive. A single millisecond of lag or some tiny UI glitch, that can literally mean catastrophic financial losses. But the upside is huge too. You're democratizing finance and tapping into a market that is just growing like wildfire. So we're going to build this machine piece by piece, relying straight on the latest architecture research to show you exactly how it's done today. Okay, let's dive into this. Here is our architectural floor plan. We'll move step by step, starting with strategy, niche, and compliance. Then designing high-stakes trading UX. After that, microservices, the back-end engine. Next up is powering trades with data APIs. And finally, fortifying security for MVP launch. All right, first up, strategy, niche, and compliance. Now, before you even think about writing a single line of code, you have to secure your legal and strategic foundation. Grounding this in reality, getting it wrong doesn't just mean you launch a buggy app. It means you get shut down by regulators before you even get off the starting line. So, who are you actually building this for? Is it a self-directed app for retail investors? A heavily data-driven platform for the pros? Or maybe a hands-off robo-advisor? Your choice completely changes your technical scope. Like, a robo-advisor needs complex AI algorithms to automate portfolios, whereas a self-directed app, that requires ultra-low latency execution systems. You just can't build both at once for an MVP. So the crucial point is that compliance isn't just a checkbox on a list. It is the absolute bedrock that keeps your platform alive and out of trouble. If you're operating in the US, you're dealing with non-negotiable licenses from the SEC and FINRA. Over in the UK, you need FCA authorization. In Europe, it's MiFID II. Canada requires zero registration. And of course, globally, you've got strict data privacy laws like GDPR and CCPA that dictate exactly how you handle money and protect user data. Then we have the KYC, Know Your Customer, and AML, or anti-money laundering, workflows. And guys, this goes way beyond just asking for a name and a zip code. You're collecting identities, verifying government docs, checking global sanction watch lists, and continuously monitoring transactions for any weird anomalies. Doing this manually? Totally impossible at scale. You absolutely need automated compliance engines to reduce human error and mitigate your regulatory risk. Moving right along to phase 2, designing high-stakes trading UX. Okay, so our legal house is in order. Let's transition over to the interface, what the user actually sees. The responsibility placed on the design team here is massive. Just think about this quote: "Poor UX changes financial behavior." That hits pretty hard, doesn't it? With a normal consumer app, bad design is just annoying. But in trading, bad design causes hesitation, execution errors, and real financial loss during those wild market swings. If a user can't find the cancel button because it's buried in some convoluted menu, they lose money, and you lose that user forever. This brings us to a really interesting design divide: professional traders versus retail investors. For decades, platforms looked like the Bloomberg terminal, basically maximum data density, complex option chains, all squeezed onto a single screen like a giant puzzle. But modern retail platforms like Robinhood totally flip the script. They use progressive disclosure, super clean typography, and a ton of white space. You get just the info you need right in that moment, preventing cognitive overload so you can actually make fast decisions. And this brilliantly illustrates how modern UX principles come into play here. The visual hierarchy has to be flawless. In finance, green means gain and red means loss. If you mess with that, you break user trust instantly. Also, one-tap trade buttons are great, but friction is actually a feature here. Adding a swipe to confirm layer creates a forced, intentional pause that stops impulsive, accidental trades. Oh, and dark mode? Mandatory. Active traders are staring at these screens for hours on end, usually in low light. All right, let's open up the hood for part 3, microservices, the back-end engine. So we're in the engine room now. Legacy monolithic apps, where all the code lives in one massive block, they inevitably crash under high trading volume. We just can't afford that in 2026. Instead, we use a microservices architecture centered around 2 crucial systems. You've got the OMS, the order management system, that is the beating heart routing the trades. Then you have the RMS, the risk management system, which is your safety layer checking margins in literal microseconds. Trading is a battlefield of milliseconds, so these 2 systems communicate asynchronously via event streams like Kafka, processing massive data fast without bottlenecking each other. Take a look at this table. A robust backend isolates four core microservices: the OMS, the RMS, market data, which is pulling in live feeds via WebSockets, and settlement, which coordinates clearinghouses and audit logs. By decoupling these functions, you build an incredibly resilient app. If your settlement service gets a sudden memory leak and goes down, it won't crash your order routing system. Users can keep trading while your engineers fix the issue behind the scenes. That isolation is your ultimate safety net. But to keep that engine room humming, you gotta follow some strict, non-negotiable rules. First, never block external calls. You need to be async only. Next, your OMS and RMS must have totally independent databases. Third, idempotency is mandatory, meaning you absolutely ensure that a duplicate network event doesn't result in double charging a user or executing a duplicate trade. And finally, use circuit breakers for any failing services. A single badly designed piece here can snowball into a massive financial disaster. Next up, step 4, powering trades with data APIs. Now, what's really interesting about this slide is it acts as your scannable cheat sheet for 2026. We built the engine, but it needs fuel. Your trading strategy is honestly only as good as the live market data feeding it. So you have distinct options. AlphaVantage is super versatile and AI-ready with MCP servers, which we'll talk about in a second. Intrinio is your institutional-grade Oprah licensed pick. EODHD gives you deep global reach across over 60 exchanges. Morningstar is perfect for independent analyst opinions, and Refinitiv provides bank-level infrastructure. You just pick the one that matches your exact niche. But listen, a very quick, stern warning for you here. Steer clear of outdated data sources. IEX Cloud, it's officially shut down, so ignore any old guides telling you to use it. And whatever you do, do not build a commercial product on unofficial Yahoo Finance endpoints. They change without notice and carry massive legal and stability risks. When real money is on the line, stability is everything. Now here's a massive shift for 2026, the rise of Model Context Protocol, or MCP servers. In today's AI era, you don't just want raw data feeds. You need MCP servers so your AI models can talk directly to financial APIs. Providers like AlphaVantage now offer native MCP servers, meaning your AI agent can query live market data conversationally. You turn raw numbers into instant, actionable analysis without building a custom integration layer. It is a complete game changer for speed. And that brings us to our final phase, number 5, fortifying security for MVP launch. Before we launch, we have to lock the whole system down with ironclad cybersecurity. But let's land the reality of the investment required here. Building this kind of app typically costs anywhere from $20,000 for a bare-bones MVP all the way to well over $500,000 for a comprehensive platform. And development timelines? You're looking at 6 to 12 months, depending on your regulatory hurdles and architectural complexity. Make no mistake, it's a very serious commitment. A big chunk of that budget goes straight to security non-negotiables. We're talking AES 256 data encryption, WAF and DDoS shielding, strict multi-factor authentication, and real-time anomaly detection. But there's a huge catch. Security cannot slow down access during market volatility. That means your biometric login, like Face ID, has to happen in less than 1 second. If a user gets locked out while a stock is tanking because your security flow is clunky, their trust in you is instantly destroyed. Let's move to and see how this builds into an exhaustive testing pipeline. Before you ever let users touch real money, you run this absolute gauntlet. You start with unit testing for your code blocks, then integration testing for those APIs. Next, functional testing ensures core features actually execute properly. Then you bring in beta users for user acceptance testing, and finally, bring in the ethical hackers for rigorous security and penetration testing. There's no skipping steps here. So, as we wrap up this explainer, I want to leave you with a provocative question. As we look at 2026 and beyond, how do we balance the incredible power of responsible AI and fun gamification without triggering impulsive and dangerous financial behavior? We know things like streaks and badges work for engagement, but in investing, they can lead to real ruin. Designing an app that is both highly engaging and deeply responsible, that is the ultimate challenge for the next generation of fintech builders. I really hope this blueprint gives you the tools you need to get started.